How's it going, wealth builders? This is your king, and you're tuned into Elite Finance King. Welcome to the Pride. Let's get into it. Today, come join me, your king, on a journey through the kingdom of investments where we will uncover the mysteries behind dividends and growth stocks. Wealth builders, whether you're a seasoned investor or a new member of the investment world, it's crucial to be aware of the different types of investments that exist. In this video, we will discuss the key differences between these two and which one might be better for your preferences. So, without further ado, listen up carefully and let's get started. Alright, before we dive into the main topic, let's take a moment to understand these two: dividends and growth stocks. Let's start with dividends. Imagine you're an owner of a profitable business. At the end of the year, after you've paid all your expenses, you have extra cash. So, what do you do with that extra cash? If you share that extra dough with your stakeholders, you're essentially paying dividends. So basically, wealth builders, dividends are payments made by companies to shareholders. It's a way for them to distribute a portion of their earnings back to the people who have invested in them, showing appreciation for their support. Now, an important part of dividend is the vibrant and dynamic concept of the payout ratio. Wealth builders, this is the lively percentage of earnings a company joyously pays to its shareholders in the form of dividends. It's like a company throwing out a financial party, and you, as a shareholder, get an invite. If a company has a payout ratio of 50%, it's like saying, "Hey, we made some money, and we're going to share half of it with you." But here's the twist, wealth builders. A high payout ratio can be a double-edged sword. While it might make you jump with joy initially because it means more dividends for you, it could also suggest that the company might not be putting enough back into its operations to grow. So, a lower payout ratio, on the other hand, could mean the company is saving up for a grand future plan. Your king here wants you to take note of that. Another thing that you need to know about dividend is the concept of dividend yield. Wealth builders, dividend yield is the annual dividend payment a shareholder gets, and it's expressed as a percentage of the stock's current price. Now, what makes this exciting is that a higher dividend yield can be like music to an investor's ears. It's like getting a bigger slice of the profit pie, and who wouldn't love that, right? However, it's important to consider the company's financial health when evaluating dividend yield. Like a high payout ratio, a high dividend yield might not always be a good thing. It could be a sign that the company's stock price has hit some turbulence due to financial troubles. While dividend yield is a useful tool for income-focused investors, it should be used in conjunction with other financial metrics to make informed investment decisions. Now, let's move on to the second topic: growth stocks. In the financial markets, growth stocks represent a significant segment. You can imagine that you're at a racetrack, wealth builders, and you're trying to pick the fastest horse that's not just quick now, but will keep getting faster as time goes by. That's the allure of growth stocks. These are shares in companies that are expected to grow at an above-average rate relative to other companies in the market. They are typically associated with innovative, forward-thinking firms that have strong potential for expansion, whether through technological advancements, market share acquisition, or other strategic initiatives. Your king must admit that investing in growth stocks is a calculated move. You're basically betting on the company's potential future success. It's about the promise, the potential, and the possibilities. These stocks don't just sit there. They're expected to climb, to soar, to reach heights that other stocks might not. But again, wealth builders, while these investments carry the potential for substantial returns, they also come with a higher degree of risk compared to more conservative investments. The markets anticipate high growth from these companies, and as such, any deviation from expected performance can result in significant price volatility. It's an investment choice that requires a thorough understanding of the company, the industry, and the potential risks involved. And as your king, I have assigned this task to you. Now, for your reference, let's look at these two examples. Amazon and Tesla, which are two companies that have demonstrated remarkable growth over the years. Wealth builders, Amazon, with its consistent growth in revenue and business diversification, including cloud computing, artificial intelligence, and logistics, has made it a compelling growth stock. As a result, investors have seen significant returns on their investments in Amazon, and the company's stock continues to perform well in the market. Tesla, on the other hand, has been a game changer in the automotive industry. The company's consistent performance in delivering electric vehicles and its ambitious plans for the future have captured the attention of investors seeking growth stocks and is a favorite among growth-oriented investors, contributing to the company's strong stock market performance. Alright, wealth builders, the time has come to determine if you're more of a dividend investor or a growth stock investor. And to know which one of these suits you well, you first need to understand the distinct characteristics of each option. If you're an investor seeking a steady income, dividends might be your preferred choice. Let your king repeat it again. Dividend stocks are typically offered by established, profitable companies that return a portion of their earnings to shareholders, often in the form of cash payments or additional shares. These stocks can be particularly attractive for retirees or those who need a regular income stream, as the dividends can supplement other income sources. Investors who are risk-averse or have a shorter investment horizon may also find dividends appealing, as these stocks tend to be less volatile than growth stocks. On the other hand, if you're willing to take more risks in pursuit of higher returns, then growth stocks might be more suitable for you, wealth builders. Then again, growth stocks are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. These stocks typically don't pay dividends, as the companies prefer to reinvest their earnings back into the business to fuel further growth. Growth stocks can be a good choice for investors who are more risk-tolerant, have a longer investment horizon, and are looking for capital appreciation. However, it's important to note that these stocks can be more volatile and could result in higher losses if the market takes a downturn. Wealth builders, take note that your choice between dividend stocks and growth stocks should be a carefully considered decision. Remember that the key to successful investing is aligning your portfolio with your unique financial objectives and risk appetite. And after that rigorous discussion, this leads your king to ask you, are you on team dividends or team growth stocks? Comment down below and let's see your fun answers. There you have it, my loyal wealth builders. If you found this video valuable, please like, subscribe, and share it with your fellow financial dreamers. Your king here appreciates that. Until next time. And always remember, Prime members, life is short and it's too easy to be average. Make a change today.